Okay, this will be the last topic for the prelim. So in the next week, we're going to discuss the week 6 as part of the midterm period. Our learning objectives here is to define what is corporate taxpayers, to identify the classification of the corporation and the tax rates per classification, and to cite an illustration of how the corporate tax rates applicable based on the classification. Okay, so if you talk about the corporation or the definition of the corporation is an artificial being created by an operation of the law, having the right of succession and the powers, attributes, and even properties expressed authorized by law or incident to its existence. So the corporation as the corporate taxpayers, this it talks about juridical personality or juridical person, where the board of directors, the stockholders are they form a corporation as a group that when it comes to filing of the taxes, the name of the corporate business appears. Okay, in the BIR, not the name of individual stockholders or individual board of directors, but the corporation business. That's why it talks about juridical person. And what are those classification of corporations? So we have two classification of the corporation. We have domestic corporation and the foreign corporations. The domestic corporation, this is a corporation which is made in the Philippines and organized under the existing laws in the Philippines. And please take note, excuse me, so that for whatever income in the domestic corporation, for whatever income earned within and outside the Philippines, that is subject to Philippine corporate tax. The second classification are the foreign corporations. These foreign corporations are organized under the law of the foreign country, okay, which is only extending office or extending corporate business in the Philippines. Please take note that if the foreign corporation, or regardless it is a resident foreign or non-resident foreign corporation, for whatever income they earn derived within the Philippines, only that will subject to Philippine corporate tax. So this is the classification of the taxability of income of the corporation. So please take note, regardless if it is a foreign and domestic corporation, regardless of the income which they earn. So if the corporation earn a business income, that is subject to basic or normal tax of 2% or 30%. So the 2% basic or normal tax talks about the minimum corporate income tax, and the 30% is the normal corporate income tax. What if the corporation earns a passive income and the capital gain, that is subject to final tax. Since we already discussed last time or last week about the tax on individuals on what the classification of the passive and capital gain. Okay, on the matrix of the organizational structure, look at the matrix of the organizational structure. So the corporation income, there are some corporations which their income is subject to taxable income and non-taxable income. So let's proceed to the first one. What are those income which is subject to tax? Of course, we have the basic and the final tax. Under the basic tax or the normal tax, those are the business income of the corporation, rent income, gains from dealings in property, not subject to final tax, and even the passive income which is not subject to final tax. Well, on the final tax, of course, we have the gains or the capital gains from dealings in property and also the passive income. And under the taxable income or the business income, please take note, when the income is subject to normal or basic tax, there should be an allowable deduction from the gross taxable income. So the allowable deduction, there are two ways. which is the itemized business expense, which is based on the financial report in accounting about the notes to financial statements, while the other one is the optional standard deduction, which is the 40% of the gross taxable income must be computed to deduct it as an allowable deduction to the gross income. And what are those corporations which are non-taxable? So please take note that are some corporations which their income or proceeds are non-taxable or not subject to corporate tax. And what are those corporations? Of course, the non-profit organization when it comes to the labor, agricultural or horticultural organizations, the non-stock and non-profit mutual savings and cooperative banks. Okay, their incomes and proceeds are non-taxable. Also, the non-stock organizations operating for the exclusive benefit of the members, like providing them of life, sickness, and accident benefits. So it talks about the insurance or the social securities. Okay, that is also their income proceeds are non-taxable. And then the non-stock corporation operating exclusively for religious purposes, like the church, charitable institution, or doing a humanitarian activity, scientific also, the DOST, when it comes to technology advancement, because their proceeds are again from the donations of the private institutions and also the budget allocation of the government, and also for the athletic and cultural purposes. So athletic purposes, like the Philippine Sports Commission, they are also corporation. The non-stock for the Filipino athletes, which is funded by the private sectors, and donations from non-profit organizations. And even cultural purposes like I guess Nayon Filipino is not yet to exist right now, but the national museums, okay, Pambatang Museo, those are to preserve the the cultural and even the tourism tourist spots in the Philippines. It is also a cultural purposes. So for those corporations who used to preserve cultural things, okay, their proceeds or income is not subject to tax. Even the non-profit business leagues, the chambers of commerce or board of trade, the non-profit civic league or organizations organized for the promotion of social welfare, the non-stock and non-profit education institutions are also not subject to, they are non-taxable. Okay, so when say non-profitable education institutions, those are managed by a church, or managed by a church or a convent. Okay, those are the non-profit education institutions. And the government educational institution, of course, those are the state and local college and universities. The non-profit organizations, which is the cooperative telephone companies, fire insurance companies, mutual ditch or irrigation companies, and even the rescue operations when it comes to the typhoons and other institutions that do rescue operations like the GMA Kapuso Foundation and the Sagip Kapamilya Foundation, which also those are the under letter D. So for whatever their proceeds, because those came from the donations of other people, so their proceeds and income are not subject to tax. Okay. And also the non-profit organizations for the farmers, fruit growers, and any similar association for the purpose of marketing products of their members. So those are the corporations which their income or the proceeds are non-taxable. So look at this on the matrix of the classification of the corporate taxpayers. It composed of the ordinary corporate taxpayers and the special corporate taxpayers. Just like individuals, okay? So let's discuss first on the left side, which is the ordinary corporate taxpayers. So if the ordinary corporate taxpayers, they are subject to normal or basic tax. So if, we all know if the ordinary corporate taxpayer is a domestic corporation, so for whatever income within and outside the Philippines, that is subject to Philippine corporate tax. And the tax base is, of course, the gross and the net taxable income that can be computed on the normal corporate income tax and the minimum corporate income tax. Whichever is higher, okay, whichever is higher between the two, that will be adapt to, paid, and collect the corporate tax. Okay, so the normal corporate income tax is the 30% of the net taxable income, while the minimum corporate income tax is 2% of the gross taxable income. So if the ordinary corporate taxpayer is a resident foreign corporation, only income within the Philippines is subject to Philippine corporate tax. Okay, so when say foreign corporation, their business are operating under the foreign law of their country or the law of their country, which is also as a corporation based in the Philippines. Of course, they earn income in the Philippines, but for whatever income in the Philippines, that is subject to Philippine corporate tax, okay? So for whatever income they earn in their country, in their homegrown country, that is not subject to Philippine corporate tax, only the income earned in the Philippines. So the tax base also is the net taxable income and the gross taxable income, and the corporate tax, the tax rate for the corporation, of course, it's the same with the domestic corporation, the normal corporate income tax, okay, and the minimum corporate income tax, whichever is higher, okay, whichever is higher. So for whichever is higher between the two, it will be adapted to collect and pay by the corporation, okay. And the non-resident foreign corporation, also income in the Philippines is subject to Philippine corporate tax, and the tax base is the gross taxable income, and of course the tax liability or the base of tax is the normal corporate income tax, which is the 30% of their gross taxable income, okay, in the non-resident foreign corporation. While in the special corporate taxpayers, we have for the special corporate taxpayers, if it is a domestic corporation, the income within and outside the Philippines, that is subject to special tax base and special tax rate. So we are going to discuss it later. And the foreign and for the resident foreign corporation, it does and even the non-resident foreign corporation as a special corporate taxpayer, their income in the Philippines is subject to Philippine tax, and also there's a special tax base and a special tax rate for those resident foreign and non-resident foreign corporations. So look at the example here. Okay, the example here is the corporation of ABC has the following data for the first year of business operations. It's the following data. So they have the gross sales in the Philippines and Australia. They have also the cost of sales in the Philippines and Australia, and also allowable business expense for the Philippines and Australia. So what we are going to find out is to compute for the corporate tax liability or the corporate tax payable under each of the following cases. If the corporation is a domestic under the itemized deduction, if the corporation is domestic using the optional standard deduction, if the corporation is a resident alien using the itemized deduction, if the corporation is a resident alien using the optional standard deduction, and if the corporation is a non-resident foreign corporation. So let us compute it one by one. So let's proceed to the first one. So the first one is that the domestic corporation, okay, if the corporation is domestic using the itemized deduction. So we say itemized deduction, that is the actual deduction of the expenses based on the notes to financial statements. So this is it is already given data on the problem. So let us apply. Okay, so of course, domestic corporation income within the Philippines and Australia. So the total gross profit is 50 million less the cost of sales. Okay, we have the gross profit of 7.5 million, the combination of the gross profit of Philippines and Australia. Together with other income and less allowable deduction as the itemized business expense, 1.7 for the Philippines and 1,040,000 in Australia with a total of 2,740,000. So therefore, the net taxable income, okay, with a total of 5,760,000, a combination of the net taxable income in the Philippines and Australia. So after that, since the net taxable income is 5,760,000, let us compute for the normal and the minimum corporate income tax. So what's the rules? So for the normal corporate income tax, 30% of the net taxable income. So 5,760,000 times 30%, that is 1,728,000. For the minimum corporate income tax, the 2% of the gross profit, which is 7.5 million, that would be 150,000. So therefore, the normal corporate income tax is greater than the minimum corporate income tax. So the normal corporate income tax shall prevail to collect and paid by the corporation to the BIR. Okay. The second one, domestic corporation, but this time we are using the optional standard deduction. When you say use the optional standard deduction, we have only to compute for the 40% of the gross profit. Okay. Same scenario. So the income within the Philippines and Australia, because it is a domestic corporation. So the total less the cost of sales with a total gross profit of 7.5 million. Okay, and then add other income and less allowable deduction, which is the 40% of 1.8 is 720,000, and the 40% of 5.7 million in Australia, 2,280,000. So therefore, the total allowable deductions is 3 million using the optional standard deduction. So therefore, the net taxable income, okay, for the Philippines is 1,680,000. In Australia, 3,820,000 with a total of 5.5 million. So after that, we have to compute for the normal corporate income tax and the minimum corporate income tax. So the normal corporate income tax, the 30% of 5.5 million, that is 1,650,000. And the minimum corporate income tax, which is the 2% of the gross profit, which is 7.5 billion, that is 150,000. So therefore, since the normal corporate income tax is greater than the minimum corporate income tax, then the normal corporate income tax shall apply to pay for the tax to the BIR. Okay, so because that's the higher. Okay, this is the computation which I already explained. The third one is the resident foreign corporation. Okay, using the itemized deduction. So if it is a resident foreign corporation, so only income in the Philippines subject to Philippine corporate tax. So therefore, let us summarize the gross sales in the Philippines, 8 million, less the cost of sales, 6.2 million, with the total gross profit of 1.8 million. Add other income and then the allowable deduction using the itemized, which is 1.7 million. So the net taxable income is 700,000. After that, let us compute for the normal and minimum corporate income tax. So the normal corporate income tax, the 30% of 700,000, which is the net taxable income, that is 210,000. And the 2% and the minimum corporate income tax, the 2% of the gross profit, which is 1.8 million, so that is 36,000. So again, the normal corporate income tax is greater than the minimum corporate income tax. So the normal corporate income tax shall apply to pay for the corporate tax, okay, to the BIR. And for the fourth one, compute for the taxable income or the income payable if the corporation is also a resident foreign using the optional standard deduction. Of course, income in the Philippines is still in the resident foreign corporation. So income in the Philippines, 8 million plus cost of sales, 6.2 million with a gross profit of 1.8 million. Okay, plus other income and then less allowable deduction, which is the 40% of 1.8 million, that is 720,000. So the net taxable income is 1,680,000. After that, we have to compute for the normal and minimum corporate income tax. So the normal corporate income tax is the 30% of the net taxable income, which is 1,680,000. Okay, that's 504,000. And for the minimum corporate income tax, okay, which is the 2% of the gross income, which is 1.8, that's 36,000. So take note, the tax to be paid, whichever is higher, or the tax to be applied is the normal corporate income tax, which is 504,000. And for the, okay, that's the computation. And for the non-resident foreign corporations, please take note, because the non-resident foreign corporation, they are not entitled to the minimum corporate income tax. So the normal corporate income tax should apply the 30% to the gross taxable income. So the gross taxable income, of course, is 1,680,000. The question is, why, sir? There is why is it that that's a gross taxable income, not the net? Because they deducted the allowable deductions. Of course, they use, but the basis of the normal corporate income tax, of course, is after the deduction of those allowable deduction to the excuse me, to the to the gross profit. So that will be the gross taxable income. So therefore, that's a 30%. So that's only the normal corporate income tax of the corporation, if the non-resident foreign corporation. Okay, so that is the computation of the illustrative examples of the compute for the corporate tax based on the classification of taxpayers. And we are talking about ordinary corporate taxpayers. Okay, so next is the minimum corporate income tax, or the MCIT. The minimum corporate income tax, this is the 2% of the gross income that shall be also applied for the corporate income tax. Okay, so this is also used as part of the ordinary tax. Okay, or the basic or the normal tax to the corporations. Okay, but take note, in applying or in the application or in order that the corporation is entitled to compute for the minimum corporate income tax, there should be also a basis, because there are some corporations which are not entitled to this. They are only entitled to 30%. But why there is a minimum corporate income tax? Just in case that whichever is higher, that would be the comparison or the application of the tax. Okay, so what are the guidelines in order to apply the minimum corporate income tax, which is the 2% of the gross profit? Especially if the corporation is operating for 4 years, or at the beginning of the 4 years, or in their 4th year of operation. The MCIT, or the minimum corporate income tax, shall apply to compute and to compare for the normal corporate income tax. But if the corporation is only operating from 0 to 3 years, or more than 3 years, but not almost 4 years, okay, so that is those corporations are still not subject to minimum corporate income tax. Another the minimum corporate income tax is applicable for the corporation if the corporation experience a zero taxable income. So it's only two if the corporation experience a break-even or a losses. So in case that if the business or the corporate business experience a losses or break-even, then it shall apply for the minimum corporate income tax. And the third one, of course, it is if the corporation incurs a loss, but take note, just in case, the Secretary of Finance has the power to suspend the imposition of the minimum corporate income tax from those corporate business which suffer losses because of the following. If there is a prolonged labor dispute between the management and the labor, and also if the corporation experience a force majeure. And of course, the fourth one, okay, the guidelines in the minimum corporate income tax is it is only applicable to ordinary taxpayers, regardless if it is a domestic and resident foreign corporations. Please take note the guidance number 5 that there are some the minimum corporate income tax is not applicable to the following domestic corporations, okay, which are not subject to MCIT. And what are those? Okay, the proprietary educational institutions, the private school, which is owned by a one person, not a corporation. Okay, and then the non-profit hospitals are not subject to minimum corporate income tax. Okay, the banking institutions under the expanded foreign currency deposit system, and also the corporations under a special income tax regime under the PEZA law or the Philippine Economic Zone Authority and the Basis Conversion Development Act. And number 6, guideline that the tax liability is being calculated at 2% of the gross income, and starting if the corporations are started on the 4th year of operation, of course, that was the time to compute both of the minimum and the normal corporate income tax to be compared, whichever is higher. So for whichever is higher between the two, that tax will be applied to pay. And of course, if there's an excess of multiple corporate income tax over the normal corporate income tax, this is accreditable because any excess of the any excess of the minimum corporate income tax over the normal corporate income tax shall be creditable and carried forward and credited, or it should be deducted against the normal corporate income tax for the 3 succeeding taxable years, provided that the normal corporate income tax should be higher than the minimum corporate income tax. Okay, the excess of the MCIT, if the MCIT should be higher in the year to which the excess of the minimum corporate income tax is forwarded. And of course, how to file for the corporate income tax? Okay, and the corporate income tax must be applied on a quarterly base and annual. So in the annual, we have to combine all the taxes from the 1st up to the 4th quarter. While on the quarterly, we have to do the interim computation of tax from the 1st up to the 4th quarter. So in the computation of the tax due for the taxable quarter, if the minimum corporate income tax is higher than the quarterly normal corporate income tax, the amount of tax to be paid at the time of filing of the quarterly corporate income tax shall be the minimum corporate income tax. Okay, so in the payment of the said quarterly, the minimum corporate income tax are the following guidelines shall apply. So please take note that excess of the minimum corporate income tax from the previous taxable years, they are allowed to be credited, but the excess of the multiple minimum corporate income tax from the previous quarters, expanded withholding tax, and the quarterly normal corporate income tax payment those three are allowed to be credited. Okay? So let's have the following example here. Okay, so the example here is the records of the domestic corporation which commenced operation in 2010 are as follows. So we have the following gross income and allowable deductions from 2015 up to 2017. So the requirement is to determine or compute for the income tax payable for 2015, 2016, and 2017. Okay, let's compute, let's break down. So the gross income for the 2015, 15 million, 2016, 17 million, and 2017, 19 million. Less allowable deduction, so that's the itemized deduction. Okay, and then the net taxable income for 2015 is 500,000. The net income for 2016 is it's not a net income, that's a net loss. It's a negative 200,000, and for 2017, the net taxable income is 1.2 million. Okay, so if you compute for the normal corporate income tax and the minimum corporate income tax, okay, so of course the basis of the normal corporate income tax is the 30% of the net taxable income, which is 500,000 times 30%, that is 150,000. And for the minimum corporate income tax, which is the 2% of the gross profit, okay, which is 15,000, that is 300,000. So therefore, we can apply, or because the minimum corporate income tax is higher than the normal corporate income tax, so that we can adopt the minimum corporate income tax. In 2016, of course, because they suffer, the corporation suffered from the loss, so that it would be zero. The normal corporate income tax is zero, but there is a minimum corporate income tax of 340,000. So the 340,000 shall apply. Okay. And for 2017, we have the normal corporate income tax of 360,000. Because it is a 30% of the net taxable income, which is 1.2 million. And the minimum corporate income tax, which is the 2% of the gross income, which is 19 million. So, of course, that's 380,000. So, therefore, we adopt again the minimum corporate income tax of 380,000 instead of 360. Okay? Because as our ruling, whichever is higher. Okay, so this is the computation, but this is the computation that we use to. Okay, so another illustration. Okay, another example here. Okay, so XYZ corporations, normal corporate income tax. We have the minimum income tax, and together with the tax withheld during the year. Okay, the excess minimum corporate income tax prior the year, and the excess withholding tax prior the year. So they have those given data. Now, these are the quarter-based corporate income tax on the first, second, third, and fourth quarter. Now, we have to determine or to compute for the following: income tax payable for the first quarter, income tax payable for the second quarter, income tax payable for the third quarter, and annual income tax payable, which is the whole quarter or the 4 quarters. So let us discuss it one by one on how to compute for the corporate income tax when it comes to the quarterly base. Okay, so first, we have to compute for the income tax on the first quarter. So of course, let us compare the corporate income tax on the minimum and the normal. So since the normal corporate income tax is higher than the minimum corporate income tax, so we can adopt the 250,000. And then less, based on the given data, less the withholding tax prior to the year, which is 20,000, okay, on the first quarter, and then the withholding tax at current year, okay, so that is so that is 90,000, and the excess, okay, and the excess of minimum corporate income tax prior to the year, which is 110,000. Okay. Okay. So therefore, the corporate income tax payable on the first quarter is 30,000 instead of 250 because we deducted the deductibles. So the normal corporate income tax is 30,000 for the first quarter. Oh, they need to pay. That's okay. So what are those tax credits to be credited, to be deducted? The withholding tax, the excess minimum corporate income tax, and the tax payments made on the previous quarters. Okay, the second one, that is compute for the taxable income on the second quarter. Okay. So let us combine the first and second quarter of the minimum and normal corporate income tax. So therefore, that is 760 and 540. So it means that the minimum corporate income tax is higher than the normal corporate income tax. So that should be applied. Okay, the 760,000. And then less the withholding tax prior to the year, which is 20,000. That is a given data. Okay. And then withholding tax for the current year, of course, for the quarter 1, 90,000. For the quarter 2, 110,000 with a total of 200,000. But the excess minimum corporate income tax prior to the year, of course, there is none because we adopt the minimum corporate income tax. So that's 0. And then the tax paid on the previous quarter, which is the first quarter, which is 30,000, is already paid. So it should be deducted. So that the income tax payable for the second quarter is 510,000. Okay. Next, let us compute on for the third quarter. Oh, that's the requirement number 3. So let us combine again the minimum corporate income tax from the quarter 1, quarter 2, and quarter 3, and even the normal tax on the quarter 1, quarter 2, and quarter 3. Okay, so that for the minimum corporate income tax, that is 1,010,000, and for the normal corporate income tax, it is which is 1,090,000. So of course we should adapt the normal corporate income tax because it is higher than the minimum corporate income tax. And then we should deduct all the deductibles, the withholding tax prior to the year, which is 20,000. The withholding tax of the current year, of course, in the quarter 1, 90, quarter 2, 110, and quarter 3, 130,000. So that's 330,000. Excess minimum corporate income tax prior to the year, which is 110,000. And the tax paid on the previous quarter, which is 30,000, and 510,000, that's 540. So the income tax payable for the third quarter is 90,000. And for the last one, for the fourth quarter, of course, we have to combine all the normal and the minimum corporate income tax from the quarter 1 to quarter 4. So for the minimum corporate income tax, that's 1,260,000. And for the normal corporate income tax is 1,540,000. So because normal corporate income tax is higher than the minimum corporate income tax, it should be applied. Okay, it should be applied or adapt to be paid. So that's the income tax payable is 1,540,000. Then let's have the following deductions as the tax credits. The withholding tax prior to the year, 20,000. The withholding tax of the current year, okay, for the whole quarter, for the quarter 1, 90,000, quarter 2, 110,000, quarter 3, 130,000, and quarter 4, 120,000, with a total of 450,000, and the excess minimum corporate income tax prior to the year, which is 110,000, and the tax paid on previous quarter, which is 30,000 on the quarter 1, 500,000 on the quarter 2, and 90,000 on quarter 3. So that with a total of 630. So it means that the income tax payable for the quarter 4, the quarter 4 is 330,000. That's the annual taxable incomes. Okay. So that is the quarterly and annual income tax payable. So if you combine the the 30,000, 510,000, 90,000 plus 330, that was the annual corporate income tax payable. It also should be applied in the ITR. Okay? So now, going back again to the matrix, so we are now going to discuss the special tax. So what are those special corporation which is under the special tax? Okay? So first is the special domestic corporation. So what are the special domestic corporation and their applicable tax as the special tax? If the special domestic corporation is a proprietary educational institutions, which is the a school, a private school, which is owned by a person, but it is in a form of corporation, that is 10% of the net taxable income shall apply to special tax. And for the non-profitable hospitals, okay, they are 10% of the net taxable income subject to special tax. But for the government-owned control corporations or GCC, like SSS, GSIS, PhilHealth, and PCSO, or the Philippine Charter Sweepstakes Office, they are tax exempt. Remember, we discussed it in the week 2 topic that government entities are subject to tax under the constitutional limitations of the taxation power. If the special corporation is a special resident foreign corporations, what are those special resident foreign corporations? Of course, we have the international carrier or international cargo. The special tax applicable is 2.5% of the Philippine gross billings. And the Philippine gross billings are the gross revenue from the carriage, persons, excess baggage, cargo, and even the mail. And make sure that this gross revenue are originating from the Philippines. Okay? It is originate from the Philippines or under the following conditions, in a continuous flight or uninterrupted flight, or in case of transshipment. So in case of transshipment, portion of the cost of the ticket corresponding from the leg loan from the Philippines to the leg point of transshipment. Next, for the offshore banking units, that's a 10% of the gross income. The branch remittances, okay, the special tax is 15% of remittances. The regional area headquarters, they are tax exempt. The regional operating headquarters are 10% of taxable income. And for the special non-resident foreign corporations, so what are those special non-resident foreign corporations? So we have the owner, lessor, or distributor of cinematographic film. That is 25% of the gross income. The lessor of the machinery, equipment, aircraft, and others. That is 7.5% of the gross income. And the lessor of the vessels chartered by the Philippine nationals. That is 4.5% of the gross income. So those are the special corporations under the special taxes. Okay, so let's have the example here. The first example here is a special tax, okay, for the education, for the private educational institutions. So the following data were reported for the current year, the business activities of student university, a private education institution. So the following, the tuition fee, the income is 525,000, and the school business related expenses is 325,000. So let us compute for the special tax of the education. So take note, the special tax is 10% of the net taxable income. So let us compute for the tuition fee, less expenses, of course. So the net taxable income is 200,000. Then 10% of the special tax on the private education. So the income tax payable is 20,000. So that is a special tax for to be computed. And another example is the international carrier, okay, or international carrier business. Let's say the Air Europe, it is an international carrier doing business in the Philippines, provided the following data during the taxable year. So they have the gross receipt for flight Manila to Paris. Okay, that's 12,500,000. The gross receipts for flight Manila to Switzerland, 6.5 million. The gross receipt for flight Paris to Manila, 4.5. The gross receipt for flight Rome to Manila, 3.5 million, and the gross receipt for flight Manila to England, 5.5 million. But take note, there are passengers were transshipped in Germany to England by another airline. So the flight from Manila to Germany is 9 hours, and the flight from Germany to England is 3 hours. So there's a transshipment, okay? So, and then the operating expenses in the Philippines is 2.5 million. Okay, so let us compute for the special tax, okay? So what is the special tax? So in the international, take note that in the international carriage, 2.5% is applied, of course, on the gross receipts, okay? So of course, expenses is not applicable. So let's identify the gross receipts, okay? So take note, the rule is make sure that the gross receipts, the flights, the mail, the passengers are originated from the Philippines. So what are those gross receipts originated from the Philippines? The 12.5 million from Manila to Paris, the gross receipt from Manila to Switzerland, 6.5, and the gross receipt from Manila to England with the transshipment. So what's the total? The 12.5 million, the 6.5 million, and of course, the 5.5 million is supposed to be, but because there's a transshipment, we have to compute for the gross receipt from Manila to for flight to Manila to England because of the transshipment. So from Germany, of course, that's 9 hours. Okay, from Germany to England, that's 3 hours with a total of 12 hours. Okay, transshipment. So we have to compute for the 5.5 multiplied by the 9 hours divided by 12 hours. So the total gross receipt is 4,125,000. The total of 23,125, 23,125,000. So that is subject to a 2.5%, but it was rounded. It was rounded to 3%. So the income tax payable is 578,125. So that is the special tax, okay, based on the taxpayer, special corporate taxpayers and the line of business. So that is our topic for today for the week 4, which is the income tax on